Every market crash seems obvious in hindsight. After the dust settles, the stories flood in. Everyone suddenly becomes an expert, pointing to the charts, the data, the warnings. Of course, the dot-com bubble burst. Obviously, the housing market in 2008 was built on sand. COVID? Black swan, sure, but the market was already overstretched. It all looks so clear. After it's too late to act. But if it was so obvious, why do most people never see it coming? There's something about bull markets that blinds us. When things are going well, when portfolios are green, news is upbeat, and momentum keeps climbing, it becomes incredibly easy to believe the story. This time is different. This time, the rules have changed. But they haven't. Markets still follow cycles. Human behavior still drives bubbles. And history always gives us early signals before it finally screams. What's most dangerous isn't the crash itself. It's the collective forgetting that happens before it. We start to dismiss uncomfortable signals. We mock contrarians. We scroll past charts we don't understand. Until one day, we care. But by then, the exits are crowded. Because here's the uncomfortable truth. The signs were there before every major collapse. Not hidden in secret memos. Not locked in hedge fund war rooms. They were right in front of us. On charts. In headlines. In the way people behaved. And yet, ignored. In this video, I am going to walk you through those repeating signals. They've been there before every major crash, and they're starting to show up again right now. The only question now is, are we paying attention this time? If you zoom out on history, you are going to see something strange. The crashes stop looking random. They start looking familiar. Different names, different headlines, but the same structure underneath. Almost every major market meltdown follows the same 5-step pattern. First comes the bull run. Optimism grows, prices rise. Everyone becomes just a little bit smarter, a little bit richer. They stop asking, what could go wrong? Instead, they start asking, how can I miss out? Then comes the euphoria. The headlines turn bullish. Retail money floods in. IPOs soar. Everyone's a genius on social media. The crowd forgets what pain feels like. They stop hedging, stop diversifying. There's only one direction, up. Next is the leverage. Greed alone isn't enough. We want more. So we borrow. We margin. We lever up portfolios and buy more of what already worked. And just like that, everyone's dancing on stilts. After that, conditions tighten. The Fed raises rates, credit gets harder to access, and liquidity starts to dry up. But by then, most investors are already fully invested, depending on momentum to keep carrying them higher. And eventually, something breaks. It might be a shock in credit markets, a geopolitical headline, or a disappointing earnings report. Nobody knows which one it'll be, but once the setup is there, the outcome usually isn't good. You can spot this exact loop in the dot-com crash, the great financial crisis, the COVID panic, the 2022 bear cycle. And now, that same pattern is back. The same conditions are forming, just with different headlines. Most people don't notice. Not because they aren't smart, but because the pattern doesn't feel dangerous while it's happening. It feels normal. It feels profitable. That's why history keeps repeating itself. At the moment, it doesn't feel like repetition. It feels like the new normal. But there's always someone who notices, someone who doesn't get caught in the hype. And more often than not, it's Michael Burry. Let's talk about why he's watching this pattern closer than most. If there's one person on Wall Street who's made a career out of not following the crowd, it's Michael Burry. He's not a flashy talking head. He doesn't do viral TikToks or run massive hedge funds with commercials and yachts. He's quiet, a little awkward, completely obsessed with data, and usually just a little too early. But that's the funny thing about patterns. You don't need to know the exact moment they break. You just need to recognize when they're stretched far enough to snap. Back in the early 2000s, Burry wasn't a market celebrity. He was a medical doctor turned investor, holed up reading mortgage-backed securities while the rest of the world chased housing profits. What he found didn't make sense. Banks were giving out loans with no income checks. Borrowers were over-leveraged. Toxic mortgages were being bundled up and sold as safe. It wasn't hidden. It was sitting in plain sight. People just didn't want to look at it. So Burry bet against it, alone, for years. His own clients doubted him. The media mocked him. But when the housing market collapsed in 2008, Burry's bet paid off, hundreds of millions of dollars. Not because he guessed right, but because he saw the structure for what it was. The same five-part pattern: euphoria, leverage, tightening, cracks, collapse. And now, he's seeing it again. In 2021, he warned that crypto, meme stocks, and wild options trading all looked like late-stage mania. In 2022, he pointed out how tech valuations were completely detached from reality. In 2023, he made headlines shorting the market with massive put options against the S&P 500 and NASDAQ. People dismissed him, said he was early or wrong. But here's the thing. He doesn't care. He's not trying to win popularity contests. And in 2025, his outlook has only grown darker. Why? Because the signals he's obsessed with are lighting up again. Interest rates are high and staying there. Liquidity is tight. Margin debt is back near record levels. Credit spreads are widening. Retail is crowded into just a few big tech names. Insider selling is ramping up. If you've followed Burry for a while, this setup will sound familiar. He's not predicting doom. He's just saying, we've seen this before. And like last time, most people are ignoring him. They dismiss the data because it doesn't fit their current narrative. But here's the truth. Burry doesn't have to time the top. He just has to be out of the way when the structure breaks. So, what exactly are those signals he's paying attention to? Let's walk through them, starting with the one that always comes first: the tightening of the liquidity. Before a crash makes headlines, before you see markets falling, one usually happens first. Liquidity starts to dry up. Liquidity is just a fancy word for how easily money moves through the system, how simple it is for people and businesses to borrow, trade, and take risks. It's like oxygen in the market's bloodstream, enabling investors to borrow, trade, and take risks. And the Federal Reserve is the one that controls the flow. When the Fed raises interest rates, it's like turning off the faucet that feeds the economy. Borrowing gets more expensive. Access to credit slows. Risk appetite shrinks. That's what tightening is. And here's the important part. Tightening doesn't break the market right away. It sets the stage. Think of it as pulling tension on a rubber band. Nothing happens at first, until it snaps. If you look at the chart of the federal funds rate, you'll notice the same setup keeps repeating. In the late 1990s, the Fed hiked rates aggressively. Right before 2008, they pushed rates to over 5%. Before the 2022 bear market, rates surged again. And now, in 2025, the Fed has adjusted the interest rates to 4.25, one of the fastest and sharpest tightening cycles in modern history. Why? Because inflation hasn't fully gone away and the economy hasn't completely rolled over yet. So the Fed is keeping pressure on. But by holding rates high, they're also locking the system into stress mode. You can already see the effects. Credit growth is slowing. Bank lending is weaker. Companies are issuing new debt at much higher costs. Smaller businesses and real estate developers, the ones most dependent on cheap money, are feeling the squeeze. And under the surface, the plumbing of the financial system is showing cracks. Look at the bond market plumbing, specifically the recent stress in the basis trade, a complex strategy where hedge funds borrow heavily to arbitrage bond prices. It's creating leverage risk in the most boring part of finance. Even the U.S. Treasury has noticed. They're watching it closely. These aren't front-page stories, but they matter. Because when liquidity gets tight, it's not just prices that fall. It's trust, confidence, stability. Michael Burry watches this because he understands. By the time the market reacts, the damage has already started. And the next place that stress shows up is in the credit markets, where problems move from invisible to impossible to ignore. So, let's go there next. Tight liquidity is the warning, but credit markets are where the real damage starts to show. Here's why. When money gets more expensive, not everyone can keep up, and the first to stumble are always the weakest borrowers. Credit markets act like a pressure test. They show stress before stocks do. Think of it this way. When investors lend to risky companies, they want extra compensation. That extra is called the spread, the difference between what safe borrowers pay and what shaky borrowers pay. When that spread starts widening, it's the market's way of saying something doesn't feel right. If you look at the CCC credit spread chart from December 2007, you'll see this play out clearly. CCC-rated bonds, the riskiest slice of corporate debt, suddenly spiked above 8%. That was months before the housing crash fully unraveled. The stress was there, in plain sight. But because stocks were still holding up, most people ignored it. Same story back in the dot-com bust. The dot-com bubble was already wobbling, but credit spreads told the story first. Junk bonds blew out to over 23%. Think about that. Investors were demanding nearly a quarter in extra yield just to lend to the weakest companies. That's not a healthy system. That's a red flag the size of a billboard. Now let's look at today. CCC spreads are back on the move. They've climbed to 7.5%. BBB bonds, the borderline investment grade stuff, are holding at 0.9%. Meanwhile, AAA debt is sitting calmly at 0.52%. That gap matters. It's the system splitting in two. The strong can still borrow cheaply, but the weak are getting cut off. That tiering doesn't stay contained for long. It usually spreads. And here's why it matters. Credit risk is contagious. Defaults in one corner ripple outward. Banks get cautious. Lending standards tighten. Companies scale back. Hiring slows. Projects get shelved. And before long, stocks aren't falling because of panic. They're falling because cash stops flowing through the economy. We've seen this play out again and again. And yet credit markets barely get attention until the fire is already raging. The cracks are there. They're real. They're growing. And they're the middle link between high rates and a full-blown financial event. And while that may sound dramatic, the real warning sign isn't panic. It's a false sense of safety. Because the more stress builds in credit, the more fragile optimism becomes. And when optimism turns into mania, the next shoe usually drops: retail euphoria. When you're living inside a bubble, it never feels like a bubble. It feels like progress, like innovation, like finally being rewarded for holding on. The funny thing is, euphoria in markets doesn't feel loud. It's not people cheering in the streets. It's the slow, subtle belief that downside risk no longer matters. And we're there again. Retail investors, everyday people, are once again crowding into a handful of familiar names. Apple, Microsoft, Nvidia, Amazon, Meta, Google, Tesla. These are solid companies, no question. But the issue isn't the companies themselves. It's how concentrated the bets have become. If you look at this chart of the S&P 500, you'll see that the top 7 companies, the Magnificent Seven, make up more than 30% of the entire index. That's the highest level of concentration in modern market history, even higher than the dot-com bubble, where the top 7 peaked at just 20%. This is what retail euphoria looks like today. Everyone owns the same trade. Everyone believes in the same narrative. Everyone thinks it's safe because it's big. But that's the risk with bubbles. They take something logical, like buying quality companies, and push it past the point of logic. Valuations stretch, expectations shoot higher, and suddenly there's no room for error. And it's not just the stocks themselves, it's the behavior around them. Social media is full of diamond hands again. People are YOLOing call options. Influencers are promoting all-in tech portfolios. Margin debt is creeping up, and every dip is seen as a buying opportunity, until it isn't. Michael Burry has warned about this moment before, not because he's against innovation, but because he's seen how quickly overconfidence can turn. When everyone ends up on the same side of the trade, it doesn't take much to flip the whole thing over. That's the real danger with euphoria. It makes people forget to manage risk. And just when retail sentiment feels invincible, someone else starts selling quietly, patiently, strategically. That's the next signal. Let's look at what smart money is doing right now, and why it matters more than ever. Markets almost never crash when people expect them to. They usually crack when everyone feels safe, when the headlines are upbeat, when portfolios are green, when nobody sees a reason to worry. And that's exactly when smart money starts heading for the exits. But here's the key. They don't announce it. They don't run for the door. They move slowly, carefully, without drawing attention. This quiet process is called distribution. When big investors trim their positions while retail investors happily buy from them, thinking it's just another pullback. Take a look at the chart from the late 1990s. leading into the dot-com crash. Tech stocks were exploding higher. Retail investors were euphoric, but the broader S&P 500 had already stopped making real progress. Institutions were selling into that strength, unloading to buyers who thought they were getting in on the future. Same thing in early 2007. The market didn't collapse the moment housing started to wobble. For nearly a year, indexes moved sideways. Retail money kept flowing in, while smart money was taking cash out and reducing exposure. By the time the crash arrived, the pros were already sitting on the sidelines. And now, in 2025, the signs look familiar. The indexes still look strong, but peel back the layers and you'll see that strength is concentrated in just a few mega-cap tech stocks. At the same time, insider selling has been widespread this year. Almost 90% of companies have seen insiders offloading shares. Hedge funds are holding more cash. Portfolio managers are trimming exposure to small caps and cyclical names, choosing safety over risk. This isn't panic, it's positioning. It's called the last comfortable moment, the stage where everything looks fine on the surface, but the smart players already know the setup is fragile. To most investors, it feels like consolidation. A pause before the next rally, a little chop in the market. Nothing to worry about. But smart money doesn't wait for confirmation. They recognize when a top is forming. They read the flows, the behavior, the signals, and they act before the crowd sees what's happening. And when distribution ends, there's no one left to buy. Liquidity disappears. Prices gap down. And the same buyers who were optimistic just days before now want out. That's how tops are built. Not in panic, but in quiet overconfidence. And what usually pushes it over the edge? Not the market itself, but something from outside the system. Something no one priced in. The last domino. Here's the thing about market crashes. They almost never happen because of a single event. The real damage builds quietly over time. Tight money, too much leverage, overconfidence, smart money slipping out the back door. All of that weakens the system. But it often takes something external to trigger the actual collapse. That final nudge is rarely predictable. It might be a geopolitical conflict, a natural disaster, a pandemic, a trade war, even a policy shift that looks minor on paper but lands at the wrong moment. When markets are stretched thin, small shocks turn into earthquakes. That's why it's called a shock, because even though the fragility was already there, the event feels sudden. Take early 2020 as an example. COVID wasn't the root problem. The market had already gone vertical in 2019. Valuations were stretched, liquidity was tight, and passive money kept pushing stocks higher. COVID was simply the match that lit the fuse. Or rewind to 2008. Subprime mortgages were the weakness, sure, but the breaking point came when Lehman Brothers went under. That one event shattered trust, and everything unraveled in days. Even the dot-com bubble didn't pop out of thin air. The setup was already unstable. What tipped it over were a few disappointing earnings reports and rising rates. That was all it took to prick the balloon. Now, let's look at today. In 2025, the backdrop is already fragile. Interest rates remain elevated. Credit stress is rising. Retail is concentrated and leveraged. Smart money is leaving. And what's hovering over all of it? Global trade tensions, sticky inflation, political uncertainty, weakening corporate earnings, fragile bond market plumbing. No one knows which one of these dominoes will fall first. But here's the truth. It doesn't have to be the biggest one. It just has to fall when the system is stretched this tight. That's why Michael Burry pays less attention to predicting the exact trigger, and more attention to the setup itself. He knows that when the pressure is built up like this, the spark is inevitable. It's never really about what the trigger is. It's about when it lands. If you've stuck with me this far, you're probably asking the same question everyone does at this point. Okay, but what do I actually do with all this? The first answer is simple. Don't panic. This isn't about fear. It's about awareness. Every market cycle looks unique in the moment. The headlines change, the technology changes, the players change. But the structure? That stays the same. We get greedy. We pile on leverage. We ignore the warnings. We convince ourselves that momentum is permanent. And then, something breaks. That's what Michael Burry pays attention to. He doesn't sit around trying to guess the exact day or the exact event. He watches for the pattern. And when it shows up, he adjusts before the crowd catches on. You can do the same. That doesn't mean selling everything and hiding in cash. It just means being intentional. If your portfolio is overloaded with the same names everyone else owns, maybe trim it back. If you're leaning on margin or options, maybe reduce that risk. If your strategy is just hoping the good times last, maybe add a plan. Because here's the big picture we're standing in right now. Rates are still high. Liquidity is tight. Credit markets are under stress. Retail is all in. Smart money is leaving quietly. And the system is one external shock away from being tested. We've seen this setup before. We can't circle a date on the calendar, but we can recognize when the story feels familiar. And data gives you clarity. It gives you options. It helps you avoid being the last one holding the bag. Markets move in cycles. Crashes come and go. But the investors who make it through are the ones who step back, recognize the pattern, and make calm, clear choices. Trump's adding trillions to the national debt. But could it be a planned market crash? Click the video on screen to find out.